Welcome to Financial Literacy, the controversial path to wealth. Today we will challenge the common advice, skip gimmicks, and focus on the central truth. The greatest barrier to wealth isn't advanced investment knowledge, it's behavior. We will reshape your perspective and build simple, repeatable systems that compound over time. To guide you, we will reference practical resources like I Will Teach You to Be Rich for Automation, The Psychology of Money for Mindsets, and The Simple Path to Wealth for Index Fund Simplicity. Now, let's begin by previewing what you'll learn today. Here is our roadmap. First, we will reframe wealth by prioritizing mindset over math. Next, we will walk through a beginner's blueprint for automated savings and debt payoff. Then, we will demystify the simple path to wealth using low-cost index funds. After that, we will highlight timeless books to deepen your understanding. We will also give you an actionable checklist, followed by quick quizzes to reinforce learning. Finally, we will close with an important disclaimer. Listen. Let's transition to the core premise. Why behavior beats raw knowledge. The central premise is that behavior is the biggest barrier to wealth. It is not market jargon or exotic strategies. Rather, it is how consistently you act. The mind map shows two sides: barriers such as impulses, lifestyle inflation, and debt traps, and levers such as patience, consistency, budgeting, automation, index funds, and building an emergency fund. With that framework in place, let's now focus on cultivating the right mindset. Mindset sets the tone for every decision you make. Drawing from the psychology of money, temperament matters more than raw intelligence. Consistency beats intensity, because small, repeatable actions compound. You can design for defaults by automating good choices so you don't rely on willpower every month. Reframe risk. Volatility is the price of admission for long-term growth. Embrace radical simplicity to reduce decision errors. Build guardrails, like pre-commitment rules, to combat fear of missing out and panic selling. Above all, practice patience, because time in the market consistently outperforms attempts to time the market. With this mindset in place, let's translate it into a step-by-step beginner's blueprint. To operationalize your mindset, start by opening separate accounts for clarity. Automate transfers so 10 to 20% of each paycheck moves to savings on payday. Build an emergency fund, targeting 3 to 6 months of expenses. Choose a debt payoff strategy. Avalanche prioritizes the highest APR for maximum interest savings, while Snowball builds momentum by clearing the smallest balances first. Automate the minimums and add a focused extra payment to the target debt, rolling the freed cash to the next balance as each debt is retired. Capture any workplace retirement match first, then fund an IRA, and select low-cost, broad market index funds. Keep budgeting simple with a rule like 50% needs, 25% wants, and 20% investing. Finally, hold a monthly money date to review progress. Next, let's visualize these flows and phases with quick diagrams. This flowchart consolidates how money moves automatically each month. It begins with the paycheck and auto-splitting to savings, bills, and retirement accounts. From savings, we verify whether the emergency fund is sufficient. If not, we keep funding it. If it is, we check for high-interest debt. When such debt exists, we use the avalanche method to minimize interest costs, with a loop that rolls payments into the next debt upon payoff. Once high-interest debt is eliminated, the freed cash is redirected to low-cost index funds. This creates a self-reinforcing system that becomes easier over time. Now, to place these steps on a simple timeline, let's move to the roadmap diagram. This timeline maps the journey from setup to long-term maintenance. In week 1, you open accounts and set auto transfers. By the end of month 1, you aim for 1 month of emergency savings. During months 2 to 6, you focus on high-interest debt using the avalanche method. From months 6 to 12, you complete building 3 to 6 months of emergency reserves. Over years 1 through 5, you steadily automate contributions to low-cost index funds while ensuring you capture any employer match. Annually, you rebalance and review fees, and you maintain a monthly money date throughout. Next, let's cement the investment philosophy that keeps this approach simple. The simple path to wealth champions low-cost, diversified index funds. Staying invested matters more than timing entries and exits. Keep fees minimal, because even small expense ratios compound negatively over decades. Use tax-advantaged accounts like a 401k, IRA, and HSA, if eligible, to boost after-tax returns. rebalance annually rather than tinkering constantly, and remain invested through volatility, avoiding panic-driven moves. With that philosophy laid out, let's compare simplicity with complexity so you can see the trade-offs clearly. On the left, the simplicity approach focuses on staying invested, using low-cost index funds, automating contributions, and rebalancing yearly. This reduces decision fatigue and errors, making the process transparent and time-efficient. On the right, a complexity-heavy approach relies on frequent trading, higher-fee products, and constant monitoring. It increases emotional stress and the risk of underperformance while complicating taxes and compliance. While specialization has its place for experts, for most people seeking sustainable long-term success, simplicity tends to win. To make this practical, let's show a sample allocation with a pie diagram. This pie chart shows a simple monthly cash flow template: 50% for needs, 25% for wants, 20% for investing, and 5% for giving. It is only a starting point. Adjust based on your income stability, goals, and cost of living. As your emergency fund is completed and debts decline, you can push more toward investing. Now let's reinforce the ideas with foundational books. This table spotlights key resources. I Will Teach You to Be Rich focuses on systems and automation. The Psychology of Money emphasizes that behavior determines results. The Simple Path to Wealth promotes low-cost index funds and radical simplicity. The Millionaire Next Door reveals that most affluent individuals live below their means. The Intelligent Investor stresses discipline and a margin of safety. Common Sense on Mutual Funds by John Bogle explains the importance of costs and diversification. Next, let's turn insight into action with a quick checklist. Use this quick checklist to create momentum. First, schedule an automatic transfer of 10 to 20% of your paycheck to savings. Second, open or fund an IRA and select a low-cost total market index fund. Third, build the first month of your emergency fund now. Fourth, list all debts with their interest rates and choose the avalanche method to minimize interest. Fifth, schedule a monthly money date to review everything. Sixth, cut one recurring fee today, such as a bank fee or a high expense ratio fund. Finally, ensure your retirement contributions are automatic and that you capture any employer match. To make sure these ideas stick, let's test your understanding with a quick quiz. Quiz time. The question is, according to this video, what is the greatest barrier to building wealth for most people? The options are: lack of stock picking tips, behavior and mindset, access to exotic investments, fancy budgeting apps. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is behavior and mindset. Consistent actions, patience, and simple systems usually outperform complex tactics. Next, let's test one more concept about investing strategy. Here is the next question. What is the default investing approach recommended for most beginners in this video? The options are: active stock trading, low-cost diversified index funds, penny stocks, crypto-only portfolio. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is low-cost diversified index funds. Automating contributions and remaining patient tend to produce better outcomes for most people. As we wrap up, let's highlight the key takeaways. The key takeaways are straightforward. Prioritize behavior by cultivating consistency and patience. Automate savings, debt payoff, and investing to reduce reliance on willpower. Build an emergency fund before increasing investment risk. Keep costs low because fees compound against you. Own the market via broad, low-cost index funds. Rebalance annually and remain invested. Continue learning from the classics and revisiting your plan. Before we close, please review the important disclaimer. This video is for educational purposes only and does not constitute financial, legal, or tax advice. Investing involves risk, including the potential loss of principal. Past performance is not indicative of future results. Always do your own research and consider consulting a qualified professional who understands your personal situation. Now, with that said, let's close out with a quick thank you and a creative call to action. Thank you for watching. If you found this valuable, please like the video, share it with someone who needs a financial reset, and subscribe for more practical wealth building content. In the comments, tell us which book you will read first, or which automation you will set up today.